In June, we hosted the Life Insurance Summit, which featured many of the top industry experts and influencers in the life insurance space. Normally, we reserve the speaker presentations only for those who came, but there's a couple that were just too good not to share. This presentation from Todd Langford being one of them. If you don't know Todd, he is the founder of Truth Concepts, and he's been featured on the Better Wealth channel many times, using his calculators and data to teach the analytical side of wealth and life insurance. But in this presentation, Todd not only shows the analytical, but the philosophical. And for me, his presentation gave me the biggest moment of the entire summit. Let's dive in.
And what I've seen, though, in the life insurance industry, it seems like we've shifted from a place of really understanding the core basics of how life insurance policy works, what it does, all of the benefits, all of the ripples, to a rate of return conversation. And as you know, a good friend of mine, Vince Sedona, says, live by the rate of return, die by the rate of return, right? And I'm a numbers guy, right? I like the numbers. In fact, how many of you are familiar with Colby and have your Colby? That's cool. Those of you that don't, I would really encourage you, go spend the $55, kolbe.com, and get your Colby profile. It is an amazing thing to have for yourself, for your family, as a relational tool. One of the things, Kim and I were talking with Hannah Kirkpatrick last night, and one of the things that's interesting, I think, that we do as humans, we think we're unique, and we think everybody's just like us. And, right, somehow the brain can rationalize those two totally opposing views. And that's where we are. So we think that people understand the same way we do. And that's the beauty of Colby, is it allows us to understand how we get things done. It's not a personality test. Those are good, and they add to that understanding of who we are. But it actually doesn't change from birth all the way through. It's something that's built into you. And the reason I bring that up is my Colby, for those of you who know what Colby is a 6338. So that means I initiate in fact find a little bit, and mainly in implementer. And the implementer in Colby means I like to use my hands, right? I like to build things. I like to have props if I'm talking to a client. So for me, I'm going to use calculators to support my message, not to be my message. And I think that's one of the problems is, you know, we've shifted. The computer, when it came out, was designed really to help with what we were doing, but it's become the focus. And if the focus is looking at rate of return and how great the rate of return is on this life insurance policy, there's always something out there that's going to be able to beat it if that's all that we talk about, right? And so I'm going to go outside of my Colby, and that's why I kind of wanted to bring Colby up. And I want to flip through some things before we get to some of the basics of the calculator that are critical that we have in our conversations. Now, you don't have to write these down. I'm going to go over 21 living benefits. We all know what the death benefit side of it is, but what about the living benefits? What about that selfish side that the client's looking at right now as to what's important to them? Don't worry about writing them down. Like I say, at the end, we'll have a QR code. You can go get the PDF and download those. It's not an exhaustive list. It's just a list. Okay. So I'm going to quickly go through so we can get to the other information. And, my Vince clicker. Okay. So under the category of cash value, we have provides a funding source to solve for emergencies. Huge, right? How many people get saved by that piece? Because the rest, you know, the difference between having something to save for emergencies and completely crashing and burning, right? A source for opportunities, ideally, that would be better than the emergency side. Provides the benefits of a savings account with a higher net rate of return, which we'll get to at the end. Has a guaranteed level premium that encourages discipline with flexibility. And I think this is an interesting piece, because what it allows us to do is actually have some discipline, because we have that premium payment, so that we actually make the premium payment and have the savings that occur. But a lot of people say, well, UL is a lot more flexible. than whole life insurance. If you understand how whole life insurance works and what's available to you, it's very flexible. The difference is a whole life policy won't let you destroy it, where a UL policy will, right? Okay. Can be a source to create a family bank. Can incentivize family values, which is true legacy on future generations. This is interesting. We had an advisor that called recently, and they were talking about a client that they had, or a prospect who had called them wanting life insurance. Why? Because of all the stuff they heard on the web about how great the return was. And by the way, we don't want to leave anything behind. Now, what they said was, why would I want life insurance if I don't want to leave anything behind? And the advisor really was looking for what calculator can I show to get them past this? And this is not a calculator issue, right? This is, have we had some people talk about some great ideas on asking questions? Some tremendous question. Trent, Master, Phil, Dave, right? It comes down to asking questions. What are we afraid of? If a client said that, I don't want to leave anything to my kids, what are we going to afraid of if we say, why is that? We're afraid that they're going to say, I really don't like those guys, so I don't want to leave anything to them. That's probably not what they're going to say. And if it is, wouldn't you want to know that now and say, maybe we're not aligned very well? But what are they probably going to say? What's that? Right. They don't want to waste it. They don't want to ruin their kids, right? And there's a lot of words out there in the internet and other places about this idea that if I leave money to my kids, it's going to ruin them. And I think from the selfish standpoint of the client, they like the idea because they think that that's all going to be cost anyway, right? The reality is having that money, called a carrot, is actually a way to incentivize or pass those values along that you hope to happen. Because now you've got a source for something that child is actually going to aspire to do. Does that make sense? Can be gifted to a child when they are the insured without transfer taxes. So it could be a future gift. Provides the benefit of a truly non-correlated asset for a portfolio. Tom Wall talked about this a little bit. When we look at bonds, right? Bonds were always supposed to be that uncorrelated asset, and they've kind of been correlated to what's going on in the marketplace. But life insurance cash value would be a truly uncorrelated benefit that could serve that purpose. Allows uncertain assets to have more certainty. This is a big one. So Garrett talks about investor DNA, right? What does that mean? The idea that investment that you have needs to fit what you're doing as far as who you are and what your involvement is so that you can actually directly impact it. I'm not saying here that that life insurance allows us to have something that's outside of our investor DNA, but even stuff that's inside of our investor DNA. Let's say that we love real estate and we like working on it. Is that a guaranteed investment asset? Oh, right. Things go wrong. What happens? We need certain assets to make uncertain assets more certain. One of the ways I like to look at it is the more certainty assets we have, the more uncertainty assets we have. And uncertainty, it's kind of spice of life, right? We like roller coasters. We like that excitement. Life insurance is boring. Those certain assets a lot of times are a little bit boring. So uncertainty adds that spice of life. But when we get on the roller coaster, do we put the seatbelt on? Right? That's our certainty piece so that we can have fun. We can enjoy the process and not get completely thrown off the ride. Right? And so if we're buying investments because they just have a return that we heard about and it's outside of our investor DNA, then most likely that is going to fail. If we buy them inside of our investor DNA and we don't have certainty assets to adjust for those uncertain items, it's probably going to fail as well. And life insurance is a great tool to fill that role instead of just having cash lay around. has a loan provision that does not show on credit reports, has a creditor protection in most states. It allows complete financing control of all loans. And this is a big one. It's not just on life insurance loans. I know a lot of times, and it's easy, right? We can call the insurance company, get the loan, but that may not be the best thing for the client at the time. And one of the arguments for doing that all the time, for going to the life insurance company and getting the loan, is we have control over that loan. But what is it that gives us that control? Is it what's that? Death benefit somewhat, but really it's the cash value, right? As far as the loan's concerned, right? It's not the loan that gives us the control. It's the cash value. And that cash value gives us control of any loan, because think about what happens with a life insurance loan. Why can we skip a payment on a life insurance loan? Because the collateral, but what's going to happen at the insurance company? They're literally going to make a loan to cover the interest that wasn't paid. All right? Could we not do that with our bank loan? If I have the cash and I had my loan at the bank, is there anything to keep me from borrowing from the insurance company to make that payment, just like they're doing internally? So it's the cash value that gives me the control of any loan that we have, if we understand that. And now we can pick the one that's going to be the best option for us at the time. It may be based on rate, it may be based on convenience, it may be based on a lot of different things. Can act as a cash flow bridge to optimize portfolio income. This is a big one. This is the idea of mitigating sequence of return risks. And it's the idea that especially during the distribution phase, during the accumulation phase, sequential adjustments on interest rates don't make a huge impact. But in the distribution phase, they're massive, because at that point in time, we lock in the losses when we withdraw money in a down market.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
It can provide supplemental income through loans and or direct withdrawals. Waiver of premium option for savings continuation in the event of a disability. Again, an optional rider. This one's huge, right? What happens to somebody who goes on disability? They're going to get at max 60% of their income. Are they saving currently over 40% of their income? No. So if they drop to 60%, what's the chance they're going to have any savings on a continued basis? None. Does this fix that? It helps. Long-term care benefits, another optional rider, and terminal illness benefits. So let's look at living benefits on the death benefit. So once we have used the cash value to help us during the accumulation phase, the death benefit really helps us during the distribution phase for ourselves, right? Because now that death benefit, well, actually all along the way, it's eliminated term insurance premium and opportunity costs along the way. So that's really during the accumulation phase. During the distribution phase, it allows for more efficient distribution strategies with all of our other assets. And that's the beauty of life insurance. And one of the things that's talked about in this program is the and asset idea, right? What does that mean? It means it makes all these other assets better. And as long as we do it in the right order, we can have both. It's not an either or. And here's one of the important things, I think, if this comes up for you. One of the questions is, well, what if I wait to buy the life insurance? Can I buy or start a 401k 2 years from now? Can I invest in the market a year from now? Can I buy real estate 5 years from now? Can I buy life insurance 5 years from now? Maybe, right? So it's important to have that in place when we're healthy. Asset replacement to unlock a reverse mortgage strategy. Okay, this is a huge one in relationship to what we were talked about with the reverse mortgage company yesterday. And that is, there's a lot of people that are afraid of doing a reverse mortgage. Why? Because they're thinking that's when I'm going to leave the kids. If we've got life insurance death benefit that will replace that asset, now then we've unlocked what was otherwise a non-income producing asset and made it into an income producer. And we haven't disinherited the kids in the process. Asset replacement for a charitable remainder trust strategy, another huge benefit for large amounts of capital gains style assets like mutual funds or stocks that have been held for a long period of time, real estate, those kind of things. Now we can give them away, see the impact of it while we're alive, get income off of that, and still not disinherit our family. And one of the interesting things is there is something called a wealth replacement trust that's often put into place with a charitable remainder trust strategy. And they're using term insurance and buying it on a 75-year-old or 80-year-old. And all the income is going to be used up for the term insurance premiums. What would happen if it was put in place early on? And that's what we need to be talking to clients about. It needs to be in place so this strategy is unlocked out in the future. Right? Okay, so here I have a list of what we just talked about, a list of the calculators and truth concepts, and there's also going to be another page in the PDF that has what I use sometimes to back up some of these items as far as which calculator number on this list would apply to that. And so if you click on this QR code, you can go out there, you can grab this PDF if it's helpful. Again, it's not an exhaustive list. Make it your own. That's what's really important. Am I going to go through this list with a client ahead of time, even though it needs to be talked about ahead of time? No, but it's going to be part of my conversation. All of these pieces, depending on the answer to the questions that I've asked my client. But I want to make sure they understand these benefits and agree that they're important before I ever talk about the rate of return in a life insurance policy. Why? It goes back to what we talked about. The life insurance policy rate of return can always be beat. But it is a multi-dimensional asset, unlike just about everything else that's happening. Almost every other asset is one-dimensional. It only does one thing, right? It's got its rate of return, okay? It's going to outperform a life insurance policy if that's all we're talking about in most cases. But not if it contained all these other items that we have. So that has to be in the conversation ahead of time, not afterwards. Okay? Does that make sense? Okay. So now we get all of those benefits. Why? Because life insurance has a terrible rate of return. We've got all this cost, right? One of the things, again, that Vince Sedona talks about often is if you put all my clients in a room and ask them a question, they would overwhelmingly say they would rather have 100% chance of getting to 90% of their target wealth than a possibility of getting to 100% with a strong likelihood of well below that, maybe even less than 50% of where they were. Okay? Does that make sense? All right. So the idea there is having the life insurance going down that road has a cost because it's not going to perform as well as other things. And if you look at the media, everybody knows life insurance has a terrible rate of return. Okay, now we can talk about, let's see what that return is. What does it look like? And what we see is what we would see off of any life insurance illustration. If you ran the internal rate of return calculation, there's 4.03%. So if we look at that 4.03, can we compare that to the 8%, 9%, 10% gross in another investment? And is a life insurance policy an investment? No, it is a savings vehicle. That's going outside of what it does. It has all these other capabilities because it's not an investment. It's accessible. All right, but If we look at the alternate account inputs, and let's think about this. If, let's say I could earn 4% of my bonds, would I have to pay income taxes on those? Okay, so if we look at income taxes, say in a 28% tax bracket, then now what we see is it would take 5.6% to do what the life insurance policy did to be able to pay the taxes and end up the same cash value that we have down here of the $2,094,000. Okay, it's not to say the life insurance policy is doing 5.6, but that's the equivalent yield of against another taxable investment. Would I have to buy term insurance if I didn't buy whole life insurance in order to provide a death benefit for my family in the unlikely event of a premature death? That's going to be another cost for not buying life insurance. So if we chose something else, the ripples of that other decision are we're going to have to also buy some term insurance that, again, is going to go away. But if we include the term insurance, when we include the term insurance, we see that what it would take now to match would be 6.02% to be able to pay the taxes, pay the term insurance, and the term insurance goes away at the end, and we lose that benefit. What about management fees? Are we going to pay those on the bonds? How about 1.5? Now we see it takes 8.27 not to beat the life insurance cash value rate of return, just to match it over that time frame. That does not look to me like a terrible rate of return. And we're talking about a savings vehicle, not an investment. It's got a tremendous rate of return, and those 21 things that I talked about earlier, it's going to solve all those problems as long as we ask those questions like we should. All right, so let's look at the chart real quick. Okay, so on cash, this is what we see as the difference. This gold line is what would happen if we had our 4% bond. This blue line is the cash value on the life insurance policy. Which one of those is more likely to occur? The blue line. And it's over twice as much as what the other one is. And what about from a death benefit or legacy standpoint? Turn off the cash just to take the confusion out. All right, again, our gold line, what happens right there? That magic place where we become self-insured, right? Okay, and so our term insurance falls off the books. We're down here, and so the difference in legacy is that. And so the point here is our clients need to understand all of those facets of the life insurance policy before we ever get to the rate of return. And then the rate of return is, hey, that's pretty good rate of return, and it comes with all those other things. If you try to do that in reverse, if you go here and then say, hey, but it has all these other things, the client is going to say, but I never wanted those other things, right? We've already gotten an agreement from the client that those things would be good to have, and they actually solve the problems. Does rate of return solve a problem? No, right? Does rate of return make our other things happen that we hoped would happen? No, it's the cash in there that allows us to, if we've got real estate, to pay for vacancies when we have a market change. How many people did everybody in 2008 when we saw the real estate market crash get hurt? No, there were some people that made out like bandits. Who were those people? They were the people that were in a position of cash. Right? Is holding cash typically a cost? Yeah. Can we hold cash, use it, and have a great rate of return along the way if we have a life insurance policy? Yeah. And the death benefit and all those other things thrown in.
Hey, thank you so much for watching. If this is something you want to learn more about or talk to someone on my team, click the link below. We would love to talk with you.